Theoretical corporate tax frameworks operate cleanly on paper, but when applied to the operational realities of multinational enterprises, complex structures, mismatched fiscal years, and shifting ownership create immediate friction. To resolve these mechanical breakdowns, the Corporate Income Tax Agency released the June 2026 public consultation drafts for Bermuda's Corporate Income Tax Act, or CIT, and the Tax Credits Act, or TCA. These amendments serve two precise functions. They resolve operational friction identified by existing stakeholders, and they synchronize domestic law with the evolving administrative guidance of the OECD's Pillar Two model rules. To understand the impact of these changes, we can group the amendments into three operational pillars. The first, temporal and accounting alignment. Second, structural restructuring, mergers and acquisitions. And third, universal compliance and accruals. With these provisions, Bermuda's tax regime steps out of foundational theory and establishes its granular operational reality. Looking at the first pillar, this timeline graphic illustrates a point of friction: mismatched reporting periods. The top timeline represents a Bermuda constituent entity with a financial reporting period ending in October. The bottom timeline represents its ultimate parent entity closing consolidated statements in December. Section 21 mandates a strict alignment mechanism. The financial accounts of the BCE must be determined on a basis consistent with the UPE's consolidated statements. If periods straddle, portions of the BCE's reporting periods must be combined to align with the UPE's fiscal year. A similar alignment issue occurs with accounting standards when calculating the opening tax loss carryforward under Section 6. This document is Section 6, subsection 5D of the proposed amendments. It addresses situations where a filing Bermuda constituent entity elects to calculate net income using an approved financial accounting standard for its opening tax loss carryforward, but later revokes that election or uses a different standard for subsequent fiscal years. To prevent standard arbitrage, the law now dictates a mandatory adjustment. The amount of the opening tax loss carryforward must be reduced, though not below zero, by the excess amount that would have been determined had the standard not been changed. The third alignment rule resolves a double taxation risk involving fiscally transparent entities under Section 27. This flowchart shows the precise vulnerability. A BCE is allocated financial accounting net income from its ownership interest in a fiscally transparent entity, effectively taxing that block of income. Later, the BCE disposes of that ownership interest, generating a capital gain based on the asset's value, potentially taxing that same value a second time. Section 27 neutralizes this risk. Any gain realized on the disposition of the ownership interest is automatically decreased by the aggregate financial accounting net income previously allocated to the BCE for that interest. By mandating these strict adjustments, the legislation eliminates temporal mismatches and standard-based discrepancies, directly binding Bermuda's local mechanics to the OECD's December 2023 administrative guidance. Moving to the second pillar, we encounter the mechanical complexities of corporate restructuring, specifically when a qualifying Bermuda Group entity undergoes a merger or acquisition. This organizational chart represents a qualifying Bermuda Group. Under Section 33 of the Tax Credits Act, if a constituent entity joins or leaves this group during the fiscal year, the timeline of that entity must be managed carefully. A mid-year exit forces the group to split the entity's fiscal year into separate portions. This triggers proportional recalculations of eligible employees, growth factors, and expense-based benefit factors, strictly tied to the time that entity was actually part of the qualifying group. However, these calculations are computationally heavy, and not all structural shifts warrant them. Consider the incorporation of a new dormant subsidiary, or the liquidation of an inactive one. Because these specific changes are non-material to the relevant inputs used in the group's tax credit computations, they do not trigger the administrative requirement to split the fiscal year into portions. Section 33 also addresses the specific handling of stub periods, particularly concerning aggregate charitable expenses. To claim certain benefits, an entity's charitable expenses in the current and two preceding fiscal years must exceed $300,000. The amendments explicitly prevent stub periods from being counted as whole fiscal years, ensuring entities cannot artificially accelerate their eligibility timeline. Structural complexity also exists internally. particularly for segregated accounts companies operating under the Corporate Income Tax Act. Looking at the amended text of Section 15, subsection 5A, we see precise structural options for fiscal transparency elections regarding these companies. An election can be made to treat any segregated account within the company as a separate entity, or to treat the company as a separate entity from its segregated accounts. Subsequently, an election can be made to treat either of those separated elements as fiscally transparent, entirely independent of the other. These restructuring rules ensure accurate tax credit allocations during complex operational events, while simultaneously filtering out the administrative burden of non-material corporate shuffling. The final pillar of the 2026 amendments tightens the enforcement and universal accrual mechanisms of the tax framework. Several clarifications have been made to the calculation of civil penalties under Sections 46B, 46D, and 46F of the CIT Act. In this split-screen illustration of the penalty timeline, the rule is explicitly defined. Penalties assessed by reference to time elapsed accrue continuously for as long as a default is outstanding. The specific date a taxpayer is officially notified of the penalty has no impact on the unbroken accrual line. Furthermore, if a penalty is calculated by reference to outstanding amounts, that penalty will automatically recalculate if the underlying tax due changes due to an amendment or correction of the tax return. The penalty for failing to file required information or documentation, other than the tax return itself, has also been increased from $1,000 to $3,000 per month, strictly aligning it with the penalty rate for failing to file the actual return. Beyond penalties, the amendments also clarify the funding mechanics for all credits under Section 35 of the Tax Credits Act. The proposed amendment dictates a universal accrual mandate. All tax credit benefits will now be accrued strictly against the Tax Refund Reserve Fund. As illustrated by these funnels, this reserve fund acts as a single centralized account. Benefits are drawn from this exact same fund regardless of whether they are claimed by a corporate income taxpayer or a non-corporate entity operating entirely outside the scope of the CIT regime. This standardization locks all participants into a uniform compliance environment and provides the jurisdiction with a single, highly predictable accounting model. Viewing these amendments holistically reveals a rigorous tightening of the operational life cycle for any multinational enterprise based in Bermuda. This tightening is balanced by specific administrative flexibilities, as seen here in the amended definition of the 5-year election under Section 2. The legislation now grants the Corporate Income Tax Agency the explicit power to permit an early revocation of a 5-year election, or to allow an entity to make a new election before the standard multi-year lock-in period officially expires. From the strict temporal alignment of accounting periods, to the proportional calculation requirements during corporate restructuring, to the universal compliance metrics enforced by the agency, the June 2026 drafts provide the specific mathematical patches required to achieve flawless synchronization with OECD Pillar Two models. For compliance teams and legal counsel, this creates an immediate mandate. Practitioners must model these exact adjustments against their current consolidated financials now, long before the scheduled parliamentary debates conclude. Mastering these mechanics is the absolute baseline requirement for operating within Bermuda's modernized tax ecosystem.